but don't make trading the reason for excitement. Yeah, that's a loser's strategy. All right, so very, very just simple, just to recap what I've just said. The majority of people are in this business or trading, or they're gambling, they're not trading. There's a lot of people now in the FX market who think they actually have a system. They're just random number generators, yeah, they're just guessing. But it's actually a good thing about these people, because these people fund the winning traders, which I am, and I hope soon you are going to be as well. Interesting study that was done by a Professor Lawrence Harris. It was done some years ago, and you can actually download the report. The URL's on the screen there, and you've got that in your workbook as well. Have a little read through that. And it went through, it was done in the States, it was done, who wins, who loses in the futures market. But enough of that. 80-20 rule. Some of you that have been in sales or business, you've probably heard of the 80-20 rule. And it comes back from a fellow Italian, Wilfredo Pareto. And this is what Pareto basically said. 80% of the land wealth in Italy was owned by 20% of the population. Later on, he was in his garden, and basically he noticed that the majority, 80% of the peas were produced by 20% of the pea pods. Yeah, so only certain plants were producing lots of peas, and other plants were producing anything. 80% of your business comes from 20% of your customers. Yeah, I can tell you this for a fact. Yeah, the airline business know this. The first and the business class part of the aeroplane makes more money than the rest of the plane. Yeah, it's very, very important to an airline. Business and first class is very, very important. 80% of the website traffic comes from 20% of the users. And I don't know if you know this, the majority of internet traffic right now is down to YouTube and video. They use more bandwidth than all the other sites put together. 20% of the meeting provides 80% of the results. There's a lot of companies now, they don't put chairs in meetings. So, because if you stand up instead of sitting down comfortably, you're more likely to keep the meeting short and be more productive. 80% of errors and crashes in Windows and Office are caused by 20% of the bugs, and that came from Microsoft. Now you're saying, Vince, why are you telling me all this? I thought I was here to learn to trade. You are here to learn to trade, yeah? This is all relevant. Remember what I said to you? This is all a jigsaw puzzle. And now listen to this. 80% of our profits come from 20% of our trades, all right? We're not bothered about how many winning trades we have. As long as those, as I've already explained, the trades that do go right, we let them run and they make big, and the trades that are wrong, we don't lose too much on. 80%, 90% of the techniques, indicators are worthless. As we'll go through a package called ShareScope, there's loads that I won't show you in ShareScope. Why? Because really you don't need to know it. Back to the 80-20% rule. 80% of gains in financial markets come from 20% of the time. This really happens a lot in commodities. A commodity can do nothing for years, months and years, and then in 2 months it can double or it can halve. It can have all its gain. I'll show you the cotton market a little bit later on, and you'll see cotton did nothing for ages, and then literally in months it was up over 100%. 80% of traders don't make money or break even. 20% of traders make massive returns. The other thing, I'm talking about people losing money. There's also a lot of traders who just don't actually beat the buy and hold. Yeah, so imagine the S&P 500, which is the benchmark that a lot of people use. If the S&P 500 is up 7% and you've been trading your ass off and you only make 5%, what was the point? Yeah, you were better off just buying and holding. Yeah, so that's what I mean by people that can't beat the index. So how can I teach you to trade in a short period of time? Well, basically, I've done a lot of the preparation for you. And as I said, I've already distilled it down. So there's a lot of things we're going to skip and not go through, purely because they're not that important. And we're just going to really concentrate more on the 20%. Now, all trading, whether it be the stock market, commodities, currencies, art market, property market, because it's all the same thing, yeah? Classic car market, they're driven by two things. And that's basically greed. Right? Investors get greedy, and the best example that I can remember of greed was the late 1990s, which was the dot-com boom, where it didn't matter if your company made money, it just launched, as long as it had .com or telly in it, you could have floated it and people were buying it. And then on the other side, what do we have? Well, we have greed. Yeah, so we've got greed, and then we've got fear. Fear is where nobody wants to touch the stock market, nobody wants to buy gold, And you know, lately, the end of 2008, 2009, there were very good companies that made money, were even paying dividends, and nobody wanted to touch them. And that was actually a very, very good time, you know, to actually start buying into markets again. So emotions swing between greed and fear. And remember, all markets are about people, yeah? It's all very well you saying, oh, you know, the market does this, the market does that. Well, who is the market? Yeah, who is the market? Well, we are the market. Yeah, we as people, we are the market. And here's a good example of the NASDAQ composite. And for those that don't know, the NASDAQ is, and especially this time, is a lot of internet stocks, a lot of the higher growth. And we saw what happened in 98, in 99 up to 2000. We saw the big peak, and then equally we saw the spectacular crash. Now let me explain something to you. You might think, for a market to keep going up, it needs people to keep buying. All right? Well, that's true as well, because what you've got with, if you imagine what we just showed you there in the pyramid, you've got people who are coming in, and everybody's interested in the NASDAQ, and they want to keep buying, they keep buying. And then what happens at the top? It's not that people start selling, it's that there's no more buyers coming in. You see, you need more people. I know it sounds awful, but you need another fool, a greater fool, to keep buying stock, paying higher price than you paid for it. So what happens is then, if there's nobody else to come in, then the prices start coming down, and then selling starts coming in, and so on and so on. So understand this, markets, to keep going higher, you basically, you know, you just need more fuel. You need people to keep coming in. But at some point, when everybody's already bought into it, then you've got nobody to keep pushing the market further up. That's when you start seeing markets come off. This is the pyramid, and I know it's a horrible thing to say, a pyramid scam, but have a look at this slide here and let me show you. A complete price cycle. Okay, so disbelief. Belief. Total belief. Disbelief again on the downside, and then finally belief. So a market, let's say for instance the gold market back in about 2000, nobody's interested in the gold market, yeah? Brokers are not trading it, there's nothing being written about it, you know, oh, gold market's never going to go back up again. Then it starts picking up, and people now believe that gold is a great investment. Then total belief, everyone's talking about gold. You get into a back of a taxi and people want to talk about gold, and it's loads of books are written about gold. Then gold starts coming down and people disbelieve it and say, oh, it's all right, you know, it's a good investment, I'm a long-term investor. And then what happens? The market crashes back down again, and everyone thinks, oh, gold's terrible, it's never going to be the market. And the cycle carries on and carries on. Yeah, so things are cyclical. It's a bit like fashion, you know. If you've got something and you keep it in your wardrobe long enough, it will go in and out of fashion probably 3 or 4 times in 10 years, because fashion retailers know they can't just sell you an item once and say, oh, this is good for the next 5 years. You know, God forbid they'll go broke. It's like Microsoft, they know they've got to keep upgrading you. Yeah, there's always an upgrade. You know, Apple is a fantastic company. I own stock in Apple, I have done for a few years. It seems as soon as you buy an Apple product, you know, 3 months later there's a new product that's just come out. So understand, you know, things are cyclical, they cycle, and things come in and out of fashion, and we see that in markets. So right now, as I already said, Forex seems to be the market of the flavour of the month. Well, the truth is actually the last few years you've made more money in commodities than Forex, but that's another matter. So this is another chart, you know, as I say, takeoff, media attention, enthusiasm, new paradigm, you know, different this time, yeah? Whenever you ever hear someone says it's different this time, you should always worry, because it's never. And then you return to the mean line here, which basically is, you know, the average. So markets can basically go over the mean and below the mean, but normally they come back to, you know, an accepted sort of standard. Tulip bulbs, if you've done any sort of history, and you've probably heard about tulip bulbs back in the 16th century, in Holland they'd gone wild for tulip bulbs, and people were trading tulip bulbs, and you could buy a house for the price of a tulip bulb. And this is, you know, a sort of chart from that sort of time. What happened eventually, of course, tulip bulbs collapsed, and a lot of people lost their fortunes through it. Some people made some good money, you know, they sold out their tulip bulbs and actually bought some houses and various real estate, and did very, very well from it. But the majority, of course, you know, got caught up in the mania. So See what I mean? What's the difference between a tulip bulb and internet stock or a